Hello students, welcome to Tax Mom classes. Today we are going to see how to do a problem in income from house property, and mainly I am focusing on a house property where the part of the house property is self-occupied and a part of the house property is let out. So let's see the question. Mr. Aravind purchased a house in Madurai on 15 September 1998 for 10 lakhs. For this purpose he took a loan of 6 lakhs at the rate 13% interest from a nationalized bank. When you see this point, we have to get a point that this person, Mr. Aravind, is allowed as deduction under section 24B. What is this section 24B? If any person is taking loan for purchase or for construction or for reconstruction, renewal or repair of a house property, and if a person is taking loan and interest he is paying, the interest amount will be allowed as deduction under section 24B. So we have to see whether it is taken before 1999 or after 1999. So according to the provisions, I have already discussed in a separate video, you can go through that. So according to the provisions, the loan is taken before 1999. So what is the provision? The actual interest amount or the 30,000, whatever is less, will be allowed as deduction. So remember here only the interest amount, whatever the interest amount the person is paying, that amount will be allowed as deduction. Coming to this question, here he have taken loan on 1998 for 6 lakhs. If still the person is having outstanding loan, still the person is paying interest, then only we have to give a 24B deduction for this person. So see the next point. Mr. Aravind is using 1/3 of the house for his residential purpose and 2/3 of the house was let out on a monthly rent of 5,000. So we are going to focus on these 2 points where 1/3 of the house is for residential purpose and 2/3 of the house is let out. So we have to prepare 2 charts. One is 2 statements. One is income of residential property, and the second chart is the income of let out property. So the residential property, whatever the income will be there, means the gross annual value will be nil. In the same way, the net annual value will also be nil for the residential property. And see, coming to the 2/3, what will be the GAV means? We have to go through the provisions. What are the provisions? We have to go through the fair market value, we have to see the municipal value, we have to see the standard rent. But all these 3 things are there. We have to proportionately take these amounts for only the 2/3 of the amount we have to take. All the amounts we have to take 2/3 of the amounts, and we have to go through the provisions, and the amount what we will get, we will name it as a gross annual value. When it comes to the rent, 5,000 into 12 per month we have to take. So when we go through the provisions, we will get the gross annual value, and we can go forward with the amount. So see the next point what they are giving. Rent of the similar house for let out portion is given. So here if you can see, they are giving directly for the only let out portion. Let out portion means the 2/3 of the portion they are giving. What is the rent of a similar house means? This is fair market value. They are giving fair market value. They are directly giving over the 2/3 of the house only. So we can directly take 4,000 into 12 directly. And municipal value for the whole house they are given. So when they are giving a whole house, that means 48,000 per annum they are giving. So we have to take only the 2/3 of the amount into consideration. And see the next point. The expenses paid by the owner is municipal tax 7,200. Here also 7,200. This is paid for the whole house, right? So we have to take separately for the self-occupied and let out. Whereas self-occupied, it is not allowed as deduction. Why? Because GAV as well as NAV will be nil. Here the 2/3 of the 7,200 will be allowed as a deduction in computation part of income from house property, which is let out. Insurance is 800. Insurance, it is not allowed as deduction. Why? Because irrespective of the expenditure, standard deduction, what is 24A standard deduction, 30% of the net annual value will be allowed as deduction. So irrespective of the expenditure, whatever the expenditure he may have, the total 30% of NAV will be allowed as deduction. And see, an outstanding loan amount is 4,80,000. So outstanding loan amount is 4,80,000. On this 4,80,000, 30,000, we have to calculate again, we have to divide for self-occupied and let out separately. On 4,80,000, we have to calculate 1/3 of the interest for self-occupied and 2/3 of the interest for let out property. And as the loan is taken before 1999, we have to take the actual interest amount or the 30,000 we have to compare, and whichever is less, that amount will be allowed as deduction. And see the next point, expenses paid by the tenant. See, the expenses paid by the tenant is nowhere related to the income from house property. Whatever the expenditure he is paying, that is not allowed as deduction for a computation part. So we need not worry about these points. And see what they are asking, compute income from house property for the current assessment year. So here we have to draw two statements, right? One is for the self-occupied and another is for the let out property. And what is the other thing we have to calculate? Working note 1 for the gross annual value and working note 2 for the computation of interest amount for self-occupied and let out. So let's see how to solve the answer. So see, we have to, as I said, we have to show two statements. One is a computation of income from self-occupied property. Another one is computation of income from let-out property. So see, coming to the self-occupied property, as I said, the gross annual value as well as the net annual value will be nil. If the net annual value is nil, the deduction under section 24A will also be nil. So in this case, we will get only one deduction, that is a deduction under section 24B, interest on borrowed loan. We are going to calculate that under the working note 1. So when we deduct this deduction from the net annual value, we will get loss from house property, right? We won't get income from house property, but we will get loss. Why? Because we are deducting and we don't have any net annual value, we will get loss from house property. And coming to the point of computation of income from let out property, the gross annual value we have to compute according to the provisions. So we have to compute in a separate working note. I'm naming it as working note 2. And the municipal tax, if it is paid by the owner, we have to give it as a deduction. The amount what we will get from we deduct the municipal tax from the gross annual value, the amount what we will get will be called as net annual value. From there, we have to give two deductions, that is 24A and 24B. 24A will be given on 30% on NAV, the NAV whatever the amount we will get, on that amount we will give, and 24B we will be calculating in a separate working note number 1. So if we deduct these two deductions from the net annual value, we will get the income of the house property, right? So we have to compute two working notes. Working note 1 talks about interest on borrowed loan of self-occupied and as well as the let out property, and working note 2 talks about the gross annual value. So let's see the working notes. So in working note 1, we are going to calculate the interest amount. For self-occupied, as I said, the provision says actual interest or 30,000, whichever is less will be allowed as reduction. So what is the outstanding interest loan amount means 4,80,000. What is the interest rate? 13%. And what is the self-occupied property? Only 1/3. So 4,80,000 into interest amount, on the total interest amount, the self-occupied property is 1/3. So I'm taking 1/3. So I'm getting it amount as 20,800, or the 30,000, whichever is less means 20,800. So this 20,800 will be allowed as deduction for which one? Income from self-occupied property. So deduction under section 24AB for self-occupied property is 20,800. So we have to take this amount in the first statement. So we have to take that amount 20,000. Let's see, 20,800 here. So it is a deduction. It is a deduction. So we have to deduct from the net annual value. So we are getting a 20,800 as a loss from self-occupied house property, right? It is a loss from self-occupied property. Then we have to move forward with the second one. Before that, we will compute this income from borrowed loan for the let out property also. Provision for the let out house property, the total actual interest amount will be allowed as deduction. So 4,80,000 is the loan amount and 13% is the interest amount, and for the let out property is 2/3. So if we compute, I am getting it as 41,600. So the total 41,600 will be allowed as deduction under section 24B, for which one means for the income from let out property. Done. So now coming to the computation part of gross annual value for the let out property. The gross annual value for the self-occupied will be nil as well as NAV will be nil, whereas we have to compute the gross annual value for the let out property. If we can see the question, the municipal value is given 48,000 for the whole house, right? So see the municipal, the rent of a similar house, the let out portion is 4,800. That means it is a fair market value. They directly gave it is for the let out portion. So we have to directly take 4,000 into 12. And municipal value, the whole house they have given, it is for per annum. That means 48,000 for the whole building. But we are calculating the gross annual value for only for the let out portion. So we have to take only the 2/3 of the portion. So 48,000 into 48,000 into 2/3, we will get the municipal value for the let out portion. If we can see here, there is no standard rent is given. So we have to, we cannot take standard rent, but we can take the actual rent received for how many months? For how much? 5,000 per 12 months is the actual rent received. So see the provision. So when it comes to the provisions of gross annual value, I made you to learn in a 3-step manner. In some of the books we can learn from directly in a 2-step manner, but I explain in a 3-step, that will be very easy. So what is the step 1? Talks about municipal value or the fair market value, whichever is higher we have to take that amount, or the standard rent whichever is less we have to take that amount. What we will get will be called as expected rent. So expected rent or actual rent, whichever is higher, that amount will be called as gross annual value. So now coming to the question, the municipal value is given 48,000 for the whole building. So we have to take only for the let out building. So I am multiplying by 2/3, or the fair market value 4,000 they directly gave for the let out portion, 4,000 into 12. So in these two things we have to take the highest value, that is 48,000 I am getting. In the step 2 or B, we are taking 48,000 or a standard rent. Here standard rent is not given, so I am directly taking 48,000 as the expected rent. So when we get the expected rent, we have to compare this expected rent with the actual rent received. So expected rent is 48,000 and actual rent we are receiving 5,000 per every month. That means 60,000. In these two things we have to take the highest of the value and we have to name it as gross annual value. So we are getting a gross annual value for the let out property is 60,000. So I am going to take that 60,000 in the gross annual value amount. See the next thing, we have to take the municipal tax paid by the owner. So let's see the question for the municipal tax. So see the expenses paid by the owner is municipal tax 7,200. So 7,200 we have to take for the let out only 2/3 of the amount. So 7,200 into 2/3, what amount we will get? Means we will get somewhere around 4,800. So we have to take that 4,800 into the statement. So I am deducting 4,800. If you want, we can give the multiplication here. So 4,200, if I deduct it from the gross annual value, the amount what we will get will be called as a net annual value. So we are getting a net annual value as 55,200. So from now here we have to give deduction under section 24A, that is 30% on NAV. What is the NAV we are getting? 55,200. 30% on 55,200, I am getting somewhere around 16,560. And interest on borrowed loan, already we have calculated. See what amount we are getting? We are getting 41,600. So the 41,600 will be also given as a deduction. So total this amount and take that amount to the outer column, it is allowed as deduction. I am getting it as a 58,160. So this is a deduction. We have to give it from the net annual value. If we can see now also we are getting a loss from house property. How much is the loss we are getting? 2,960 is a loss from house property. So Mr. Aravind is getting lost from the both the houses, that means self-occupied property as well as the let out property. So we can take the total amount in a separate column. We can write here the total loss from house property. We can add the total and we can write it here. So this is the procedure how we have to do such type of problems where a part of the property is self-occupied and part of the house property is let out. We have to compute two different statements, that means we have to show in two different tablers, and we have to compute two different working notes for the gross annual value of a let out property and gross annual value of a self-occupied property. You can give a working note number 3 and you can just give a point that the gross annual value and the net annual value of a self-occupied property will be nil, so that you can explain why you are taking the nil amount. So this is how we have to take solve the problems where the house property is partly self-occupied and partly let out. So the amount, the gross annual value, the provisions we have to proportionately take to the value of the let out property only. So I think you have understood the concept. Thank you for watching.